Good morning, everyone, and thank you for joining us today. My name is Razi Christians, and I head up the distribution team at PPS Investments. Our topic today is our rapidly changing economy and finding opportunities within this flux. We will also discuss ways to ensure that your client is actually well positioned to take advantage of these opportunities. So our first speaker today is Cy Jacobs, co-founder and CIO at 361 Asset Management. As many of you know, 361 is the partnership manager for our PPS managed fund. And Cy will provide us with an overview of the fund and highlight where he sees opportunities going forward. Joining Cy for a macroeconomic overview discussion is our CIO, David Crusoe, followed by portfolio managers Riza Hendrickse and Luigi Marinas, who will share some insights on the importance of manager research, selection, and blending to deliver good returns for your clients of the long term. We have made provisions as well for Q&A at the end of the presentations, so please post your questions in the chat and I will address them to our speakers. So without further ado, I hand over to Cy Jacobs. Good morning, Cy.
Good morning. Thank you, Razek, and thank you for the introduction and welcome to all of you here this morning. First of all, a very big thank you to PPS. We've had a very good relationship now for a number of years, and thank you for including us here this morning to present to all of your clients. Just to run you through a little bit of history around 361, many of you may not know us as well as you do some of the larger asset managers in the country. We have for 15 plus years been running multi-asset strategies. If you look here on the graph in front of you, look from the most conservative fund. We are a hedge fund manager. In fact, we also are the biggest hedge fund manager in South Africa. We consider that together with the likes of the PPS managed fund and our flexible opportunity fund to be a more conservative approach to the markets, trying to cater for all types of market conditions, not to be too aggressive, to have a mix of opportunities in fixed income, in equities, in cash, and obviously to move those balances around over time. And then moving more to the right-hand side, where we start getting more moderate to aggressive approaches, having a general equity fund, a specific SA equity fund, and more recently, over the last few years, managing a global fund totally outside of South Africa, which is 100% focused in offshore equities. I think it's important just to have a brief look at our team. I think many of you wouldn't have been introduced to our team before. A very well experienced, highly qualified team. The good news about our team is that our two most highly qualified people are our two females, both Tumi and Zandile. Tumi and Zandile, as you can see, the list of degrees under their names, including MBAs from recognized universities offshore. And just so you know, Tumi has all those degrees cum laude. The rest of us also pretty highly qualified and very well experienced, myself and Evan having more than 25 years in the market, and many of the other team members, north of 15 years, a very diverse, well-qualified bunch, which we think can stack up against pretty much any institution in the country. So how have we done? I mean, over the years, we've been managing the PPS managed fund. I think we're pretty proud of our performance. In fact, all our mandates that I mentioned in the first slide, we have actually outperformed our benchmarks quite handsomely. In the PPS managed fund, just to let you all know, as many of you are investors, year to date, we're up, some 2% ahead of the benchmark, 2% ahead of the multi-asset high equity benchmark, which is our peers. So effectively some 13% year to date. Over 1 year, a very nice healthy return of 17%. More important is 2 years per annum, it says on the graph, but in fact it's 3 years per annum at 15.5%. And then since inception, again running at approximately 15.5%, some 5% ahead of the sector, which is a very healthy return considering markets have been tough for some time. More importantly, I suppose, well, as importantly, is just ensuring, particularly with balanced funds, and particularly where there are people who need to withdraw funds on a regular basis. It's great to have a fund that doesn't have too deep a drawdown and doesn't have too much volatility, because as you know, Many of these funds have monthly withdrawals coming out of the funds, and obviously you don't want to withdraw from these funds if the fund were to take a big knock in any particular market. So if you compare the funds, to what we see in the sector, you will notice that our volatility, in other words, our standard deviation, or the amount that the fund actually moves by in any given market, is substantially lower than the balance of the sector. And the biggest drawdown we've had in a particularly bad market, which in fact was as COVID struck in March of 2020, you'll see the fund at a maximum point from its high to its low only moved as much as 8.6%, where the sector average was in fact almost double that at 14.4%. Another way of looking at this, and we don't like to mention too many names, so you can imagine who they are, but we took our fund, which we manage on, your fund, which we manage on your behalf on the extreme left, and compared it to the 5 largest companies that manage similar funds in the sector. I'm sure you could guess, in fact, all of you, of whose names those are. We won't point out who fund 1, 2, 3, 4 is, etc., or the average, but you can see our return, for example, relative to our drawdown. And you'll notice that if you combine the two, that would be better than any of the large managers out there over the period that we have managed this fund. So really, how do we go about things, and what are we about, and how do we find these opportunities? So for us, very much, stock selection we do from a bottom-up fundamental analysis. And this is where we dig very deep into businesses. You'll see from a later slide, there are many businesses that we obviously have never invested in. And this is because we have our own, number one, forensic ability to look rather and test what management are telling us, look deeply into financials, and very importantly, because of our size and the nature of our business, we are style agnostic. So we don't like to bucket ourselves as a value player or a growth player, but rather look at the quality opportunities on both sides of the spectrum. We recognize that markets have different cycles, and we look to play in all those cycles. And very much our portfolio gets rotated very much depending on what we feel about the macro. And we use that macro, very importantly, to overlay any underlying opportunity we find. At all times, we test our portfolio for various risks, whether it be a commodity risk, whether it be a currency risk, whether it be an overall strategy risk. And very importantly, that's day-to-day monitored and adhered to on a continual basis. As I mentioned, the deep dive into bottom-up shares and bottom-up opportunities gives us the opportunity to really explore these businesses in a very big way. And as all of you know, over the last number of years, there's been some very big disappointments in the market, very big, where management's either lied, there've been frauds, there's been overvaluations, provisioning incorrect, whatever it may be. We're glad to say that most of these opportunities, in fact, pretty much all the ones you're seeing here, were luckily things we managed to avoid, from the Steinhoffs, which many people got caught on, to the Breights and the EOHs, to in fact the property companies like Fortress and Resilient, which in fact we land up actually identifying for the balance of the market, and many other opportunities that many other asset managers landed up falling foul to. Luckily, given the extreme depth of our research team and given the kind of forensic work we do, managed to avoid all the big disappointments in the JSE over the last 5 years. Also with us, we're not the same size as many of the larger asset managers, so we are able to be nimble and flexible and move our positioning around. And this is a particular month, for example, those of you watching what's happening and unfold, where the market, for example, is down between 4 and 5%, and we've seen a massive pullback in the platinum group metals basket price. In fact, it's halved over the last number of weeks. And because of our flexibility, and we kind of saw this coming, and we understood what was going on in the semiconductor space, and we saw the demand falling up, so we managed to reduce a lot of that exposure. And the same goes with our asset allocation. It's always dynamic. Coming into 2020 last year, we did see a bit of an issue coming with COVID. We wanted to hold a lot of cash. We've done that from time to time. And if you look at our portfolio today, in the month of September, again, been building up a little bit of cash, moving some of those more high-risk positions out, lessening our technology exposure. And this is what we do as well on the asset allocation side. So bonds, cash, equities, foreign cash, we look to dynamically change where we find the opportunity set. So our other ability we really think is large, and you saw this from the volatility and the deep drawdown percentages in the first couple of slides, is our ability to try and protect capital where we see periods of extreme volatility. And obviously one of those periods was coming into COVID last year in the first quarter of 2020. And if you look how the fund performed phenomenally well, the small little red block on the far left, you can see we only lost a fraction of what the sector lost, and we lost a real tiny fraction on what the market lost. The market losing over 20% in that first quarter. Obviously, when the market bounces in the second quarter, we may lag the market, but again, we're about consistent returns over a longer period of time. And you can see in quarter 3 and quarter 4 still making a reasonable return, and during a very volatile period of 2020, still producing a very substantial return, double-digit return, compared to the sector which lacked that, and obviously the market which actually turned out to be basically flat for the entire year. The other thing we like to do in rotating the sectors and understanding those sectors well is ability to kind of bottom pick unloved sectors or shares. And one of the things we got particularly right and helped us in the 2020 year was knowing, when to in fact start buying the financials, the banks. We came into 2020 understanding that during COVID, we saw this massive acceleration of technology. And in fact, technology was our massive overweight, but we were very underweight, had very minimal exposure to banks. We understood that there'd be a fear around banks, a fear around bad debts. Earnings could be downgraded significantly. Banks are massively geared, so the equity value is rather small. So if things do digress and get bad, earnings can get massively affected. But as this COVID unfolded, we realized that governments around the world were there to support. We had a close look at it. We started understanding that provisioning had been more than adequate to cater for it. And price to book ratios were so low that we just realized there was absolutely no ways we couldn't make money on the sector. And because this particular mandate, the PPS managed fund, is really about absolute performance. We moved a lot of cash into banks. We moved some tech money into banks. We moved some other money into banks. And we landed up with approximately 10% of the whole fund just in these few names. And they performed fantastically well, and going from 0 to over 13% just in the sector in a short period of time. The other thing we've done very well of, obviously, because the managed fund has the ability to have 30% offshore and only has to have 70% in South Africa, we often get the opportunity to look at sectors across the world versus how those sectors are in South Africa. And we recognize one thing, that we preferred offshore technology to local technology, and local technology obviously in South Africa is really only now NASPAS and Process, and historically obviously has been just NASPAS. We've obviously got many risks associated with NASPAS. The Chinese risk and regulation risk has become more prevalent over the last number of weeks. And we had the opportunity coming into COVID to look at the differences between South Africa and offshore technology stocks, and preferred to rather put our cash in the offshore technology names. And you can see some of those that we have held, Alphabet or Facebook, up 64% and 40%, compared to, unfortunately, the NASPAS and Processes that have lost value on the back of, two things. First of all, a strengthening rand, and second of all, Chinese regulation and the price of Tencent. The other one thing we think we're quite good at is knowing when to be out and when to be into sectors, and to, again, like banks, to assess a turnaround story. We did this exceptionally well in Sasol, a company that we had no position in. We argued against all the larger asset managers in this country from 2017 to 2020, how we had zero. And in fact, in our hedge funds, we were short. We didn't like the Lake Charles Chemicals project. We didn't like the way it was geared. We didn't like management's hedging policy. We didn't see any cost cutting happening at the business. But then slowly things started to unfold. OPEC stepped in, management made some changes. We started to see the right things, and we realized that this business was effectively very much marginal. But if you changed those few little things, it became a very interesting story. From hadn't fallen from 400 to under 100. We were totally underweight, had nothing. We covered our kind of weights. We accumulated Sasol, and today it's been one of our biggest winners. And in fact, just looking at the portfolio today, it actually happens to be the biggest winner in the portfolio today again. So understanding really, the underlying commodity, understanding the effect that management had on the balance sheet of this business, and being able to assess that gives you the opportunity, specifically at our business, to not hold it, then to hold it, then to overweight it, because we have the flexibility to continue to change our positioning. And that's worked well in all three stages of that market. So really, where are we now? And, what do we still think, and what do we like? Well, it's very important to mention also, because the fund has obviously an allocation to bonds, fixed income, cash. How do we really feel about SA government bonds? Well, the real yield is phenomenal. So, if you look at the real 10-year yield right now, compared to many other countries, it's quite unique. It's quite unique because, we still have real interest rates in South Africa. There obviously is some risk priced into potential default of the SA government. And as a result, you're able to, for the meantime, get a real yield in SA that you're not able to get in pretty much most countries around the world, and definitely not in any developed countries. So the reason South Africa has remained with such a strong currency is partly because of this, partly because we've been in a commodity super cycle. But for now, we think this remains a very good option, and we have a reasonable weighting to SA government bonds. And as you can see from foreigners, so do foreigners have a reasonable weighting. But it is not something we would advocate, over the next decade to 2 decades. South Africa has been building up a very big debt on its balance sheet. Debt to GDP has risen significantly above expectations, but many other countries have. So I think for now, we're in a pretty safe zone. But again, a number of years out, this could change. Another thing we recognize that about South Africa, and looking at more the equity space in SA, is we've seen the market re-rate phenomenally. We have seen some very good earnings, but I think people need to understand that earnings fell off dramatically into COVID. Businesses had the opportunity to provision everything, for the market never to look at those numbers. So the numbers that we're seeing coming out of this period, kind of post-COVID or partly post-COVID, really are in our minds very much inflated on a growth rate. South Africa hasn't really changed on the whole. So if you look at the numbers going back to 2019 and 18, and you normalize the numbers that we see now for maybe taking out the excess provisions and the stimulus we've seen, we still believe South Africa, the local domestic stocks, are still under pressure. And over time, we would advocate an underweight position to these sectors. We still believe in that. And although we've seen a great recovery of many of these, we don't believe those numbers are sustainable. So we would just caution everybody to be a bit wary, because in time, with all our high unemployment, etc., we foresee the graph continue to slide down to the right. What we are seeing in the US is a phenomenon, quite an enormous phenomenon, of so much stimulus that it has effectively stimulated US retail sales and many other sectors to such an extent that it's becoming unsustainable, unless obviously that there is further stimulus. And for us, this has become a big caution. And as we see more of this, we've made good money out of a lot of this. We are rotating the portfolio to a more conservative stance, specifically on what we call long duration assets. Those assets that are effectively valued on number of years turnovers, or multiples that are just unsustainable. And there we'd like to exit most of those businesses and only really be involved in those good quality businesses that have reasonable valuations and very good cash flows. So if you look at the asset allocation of the fund, I think it's important to know we still pretty much have a high equity component. That equity component, particularly in this month, has come down a bit more. The bond component has been quite steady. In fact, the only reason it's dropped off a little bit is we had a tail of some corporate bonds, and those have come off, but we're not selling any SA-specific government bonds. We believe that to be still a good investment, a very good investment at these yields. Cash has picked up. The 7 is actually gone, north of 10 at the moment, and will be used when we think the time is right. We're also building up some property at the moment, just because yields have become a little bit more attractive, and the property sector has fallen significantly over time. And if you look at our allocation right now between offshore and local, it's almost at the 30% offshore mark. Across the sectors, very interestingly enough, and this is at a date at the end of August, you see resources at a very high number. Many of you may panic and say, wow, well, that hasn't been a great month in September. That number actually in the first week of September came down a few percent. But more importantly, we'll talk about it just now, we've seen a rotation within the resource sector. Technology is still very high, mostly offshore. Banks I spoke about. Tobacco, very conservative, giving you similar yields to government bonds, and in some of the cases, some very exciting opportunities in the chemical space, in the tobacco space. Chemicals with Sasol, one of our biggest, phenomenal performer for us over the last few months, and then going down the spectrum into all the other sectors. So if you look at the top holdings, we hold offshore equity making up a decent percentage, and you can see down the line, those stocks. Interesting to note, Impala, which is there at number 6 or so, is actually almost gone in this month. So luckily getting out of that again in pretty much in time, and the majority of the stocks there still very good. And if you look at the overall portfolio on the right hand side, 59% actually rand hedged, 41% SA Inc, and that 41% SA Inc is really a combination of more conservative stocks outside of your normal domestic retail shares, etc. We've got the banks, which we mentioned. We've got some interesting industrial companies, property, etc. So it's more trying to get us a sustainable yield and a little bit of growth, and the balance of the portfolio really to be focused around offshore. So one of the things, one of our biggest opportunities is Glencore, making up a big portion of that resource exposure. And I think for those of you who understand Glencore, a very different opportunity to the platinum group metals, and has no iron ore, and very much focused around the new electric vehicle acceleration we're seeing. Their metal mix is more around copper, nickel, and cobalt. Only really listed diversified in South Africa without iron ore exposure, which is what we like, given the ridiculous price of iron ore, which is of late come down, almost some 50%. Management has some issues with the SEC, and we're expecting a fine, but we believe all that is discounted very much into the price. And this has been a phenomenal performer for us versus the balance of the sector, especially of late, because we moved a lot of our platinum group metals exposure into Glencore over the last few months, and that's paid handsome dividends. Also, just to understand Glencore a little bit better, if you look on the far right, you can see the expectation of how much copper is going to be needed in electrical vehicles, and how much also is going to be needed in just the charging stations. And if you add those two together, the demand increase over the next decade or so is going to be phenomenal. And on the far left, if you look at that is effectively how much copper is needed in the various batteries of the various cars. The old ICE is effectively comparing the following few. That is the combustion engine, the one we're all used to driving, but all the various next 4 blocks are all your hybrid and your plug-in hybrids and your full electric buses. And you can see the extra amount of copper that's required in the size of the battery is phenomenal. So, we're expecting this to be a multi-year story. We've also seen the semiconductor shortage actually causing old combustion engines to actually grow at a slower pace now. and we're expecting even more of an acceleration in electric vehicles over the next few years. Here as well, one of the biggest opportunities we've had, and we've had this in the portfolio since the beginning of time, has been Google. All of you right now know Google, use Google. I mean, the search engine has continued to show resilience and is phenomenally profitable. Also, what's interesting is how unaffected Google's been by all the new Apple's privacy rules, which has spilled over into other areas of technology. And still, if you look at the far right-hand side, just looking at Google's growth in cloud revenue, you'll see the numbers at 40-50% per annum. I mean, to have a business that's growing at that number, but still incurring a loss in that valuation. So you strip out that loss, or in fact impute what that business could be worth on a separate listing, you have significant value. And if you're looking at the company trading at around a 20 multiple, which today is very similar to what you're finding the ShopRites, etc., and businesses in South Africa, similar multiples, you can buy this business with dollar-based earnings, with businesses that are still turning around, which is net cash, got no gearing, and has a phenomenal runway of growth. So for us, this is one of our core holdings offshore, has been for some time, remains exceptionally well priced with proper cash flows, and we believe will be something to hold for a number of years. So our final thoughts, I mean, what do we really think? Well, there are structural long-term opportunities in many equity sectors. We are cautious because I think we do recognize that markets have pushed themselves a long way, but we are still going to enjoy some type of reopening theme. It does seem to be a little bit disjointed in different countries, but we still think there are attainable opportunities in that space. There is a global capex cycle that's coming. We still got many government stimulus projects, so we're going to see global growth, there's no doubt. But we're not unmistaken or not blinded by the fact that there will be extremely high volatility in the times to come. Markets have discounted potentially a couple of years of forward growth. But we keep thinking. And at 361, we use our hedge fund cap to kind of think. We challenge conventional wisdom, try and see where we can protect capital. Most importantly, we try and avoid those landmines, which for us has been very good over the number of years. You've seen we can protect capital, and hopefully, we have a very large investable universe given our size. And over time, we seem to find those extra opportunities that give us that extra performance. So thank you very much, and thanks for all of you for listening. I think we're about to open a questions and answer session. So David, welcome to you.
Hi, Sai, and morning, everyone, and thanks very much for a very clear and interesting presentation. So one of the questions we often want to ask you, because you guys have clearly been very correct on your view that SA is on a kind of economic path to nowhere. What would it take for you guys to become more optimistic about SA's economic prospects? What are the things that you're looking for to maybe start you to shift on that view?
Yeah, so interesting. I actually I was on a webinar last night with those of you who know Bill Browder, the ex-Russian fund manager, who's actually the founder of the Magnitsky Act, and he was here talking about South Africa. And I think what it really requires to come right is actually just political will. We're aware of what's happened. We're aware of how much has been stolen. We're aware about what continually still gets stolen. If there's true political will to clean up, it's very easy to sort that problem out. There are links and audit trails to all that cash. It went through banks. It wasn't in notes. Today, there is an enormous amount of various tenders still taking place. If government, particularly the ANC, has the will to clean up this country, that would go enormously as a first step. With that extra 500 billion a year or so that's being lost, we could be on the right path to start. Whether that's going to happen or not, I'm not fully in agreement, but I think just that one little key, and we have seen maybe an element of a start of that with some arrests and some people being dismissed from the ANC. But I think that is actually the key starting objective to ensure a turn. So
you guys are still being quite cautious on that. when we look at how you're positioned today, I mean, we've had 3 years now where you've been managing the PPS managed fund for us. This is probably the most equity you've held over that period. You did mention that this month you've sort of trimmed a bit of the platinums and are maybe holding a little bit more cash. But the market's obviously stayed a little bit weak. How are you repositioning into the portfolio? Are you already redeploying into equities, or are you likely to go more conservative from here?
No, I think from here we're likely to go a little bit more conservative. I think for the one big issue is for us inflation, particularly in the US. Interestingly, he had a call from the head of Citibank yesterday, and he actually believes that inflation is a fraud in the US. In fact, the inflation numbers are fraudulently posted, which is quite interesting because you can't imagine how inflation is staying in check, given all the bottlenecks and raw commodity inflation that we've seen globally. I mean, just shipping rates themselves being up multiple times. So it doesn't seem realistic. And I think for us, that could lead to tapering, and tapering means less Fed support, and multiples are extremely high. So as soon as we start seeing an increase in rates, that's going to be the discount rate causing markets to come down. So I think for us, at the moment, we'd prefer to be a bit more conservative, continue to lighten, particularly the more expensive equities. We are seeing some opportunities like in some value sectors and diversified miners. But you can see, for example, how quick things can change. The basket price of PGMs right now has just dropped to just below 30,000 as we speak, and was at 65,000 a few months ago. So, that for us signifies, first of all, that our current account's going to come under pressure because export numbers are going to fall, given the fact that we're now exporting at half the price we were at a number of months ago. So for us, Rand maybe weakens, so effectively ensure that you've got, close to your full amount offshore would be one of the changes. Reducing some of the local equity and the more high-priced equity, maybe holding a bit more cash for a shorter period of time, and happy with a lower overall equity valuation.
Yeah, global inflation, the market seems to be surprisingly complacent about it at the moment. I suppose one couldn't say the same for the concern of global regulation. And you refer to NASPA's process complex really being hit by Chinese regulation. To what extent are you kind of thinking this is all now in the price and there's such a sort of upside from NASPAS at the moment, or are you still relatively cautious on the South African tech sector and its exposure to Chinese regulation?
Yeah, I would say we are somewhere in the middle of the two. So, having a look at how much Tencent had depreciated by, call it, a few weeks ago, it was down at the 420 mark, which is about a 40% adjustment to its valuation. And Tencent and NASPAS and Process followed suit. So actually at that point in time, if you looked through the deep discount that NASPAS trades at to Tencent, you were actually getting NASPAS on a core earnings multiple of close to 10. And for us, for a tech stock, and given all the upside you have in China, that was particularly cheap. So at that point in time, we did begin actually accumulating again NASPAS and Process. Tencent has re-rated somewhat from the bottom, even in midst of this regulation, but we're starting to see more ongoing regulation coming out, on a almost daily basis. So for now, we'd say it's relatively cheap on a longer term basis. We don't believe the growth drivers are disappearing, but we'd be more cautious and would prefer, US technology names probably in the short to medium term, but have got a smallish position. Because I think, again, it is a good Rand hedge. And in the South African equity market, having a top Chinese equity at a massively discounted price maybe is a lot better than having a pure South African company. I mean, we also have bad regulation here, expropriation without appropriation, etc., and without compensation, etc. So, we've also seen heavy regulation. So I think that regulation probably is a little bit less bad than probably what we think.
Thanks. And maybe the last question before handing back to Razek. Global inflation and global regulation are two kind of big global risks we've spoken about. What other big global risks are you kind of concerned about at the moment? And, going forward, is it fair to say the easy money's already been made? Where do you see the next while going?
Yeah, so I think the easy money on the overall market has been made. So I think many managers have had their overall portfolios uplifted by the fact that the markets have gone up, and it didn't really matter so much, where you were sitting, in which particular name, which particular company. It will become a lot more selective. So where we do think the big risks lie is in the very overvalued companies, that have potentially come to the market over the last few years that have a great story but haven't shown the potential earnings or cash flows yet. We've never seen a phenomenon of companies trading at 20, 30, 40 times turnover that still make losses. So we would caution anybody, no matter how that story, how that story sounds, rather to avoid those, together with probably most of the crypto space. And obviously, when money starts, coming out of that, when we see rates increase, the spillover will happen across the entire market, because, as you know, there's lots of leverage in the system. So, as soon as losses start occurring in any type of sector, it definitely spills over into other types of sectors. So for us, the catalyst, as you said, is inflation, is a movement in the rate curve, and we are expecting that to come. So, we are expecting the market to take some type of knock, but we are obviously, trying to protect very much against that and position ourselves a lot more conservatively over the coming months.
Thanks very much.
Thanks so much, Sai and David. You guys will be sticking it out for any questions at the end. We'll now hand over to Luigi and Riza.
Thanks, Razik. Good morning, everyone. Riza and I have regular interactions with clients where a wide range of topics are discussed. Most are fairly broad-based economic concerns or pertain to recent underlying manager performance and how that has been achieved. We do, however, also get questions about how we at PPSI, as multi-managers, go about investing. These questions are the ones I'd like to discuss with Riza today. So Riza, one of the key tenets of investing is applying a consistent investment process, and our clients are interested to know how we apply this. Can you shed some light in this regard?
We definitely have a process, and one that's actually well-defined and lies at the heart of what we do. A clear process is important because it reduces reliance on individuals, but more importantly, given that returns themselves are not necessarily guaranteed to be repeatable, what is repeatable is the process that one follows in order to achieve those returns. So for us, the process really starts with narrowing down that broad universe of over 1,000 odd funds through a process of screening. And this for us is a quantitative process, which narrows our focus on funds that have compelling return histories. And the reason we do this is because funds that have track records of above average long-term risk-adjusted returns, and so over a long enough period, could suggest to us that there is potentially some skill there that is worth us taking a closer look at. So once we've narrowed down that universe by looking at these past returns, we then need to establish whether those sort of histories are likely to be repeated going forward. And so we take a forward-looking assessment, and we do this by doing taking a deep dive into looking at the qualitative aspects of the fund and the manager. And there we look at things like business fundamentals, we look at the people involved, the investment approach, and we also analyze performance under various regimes. And so then taking all of this information into account, we then select what we think are the most promising of these managers and form a small buy list of funds, which we then select from when we construct portfolios. This then involves blending managers in various ways, depending on the multi-manager fund objectives, where we look to combine strategies that sort of in a sensible way. We also do this with a particular strategic asset allocation in mind, which we then tilt slightly over time, depending on the opportunity set. And then at the end of it all, we arrive at a multi-manager solution that we think has got a very high degree, or at least we've got a high degree of confidence in, that it will reach its return and risk objectives over a defined time horizon.
Yes, Riza. So there are a number of parts that make up a consistent process. And having a team of 8 investment professionals makes it possible to implement the process and ensure that we're constantly improving as new ideas are introduced. So the lead-on question that we often encounter then is, what's the most difficult part of multi-management? And where do we see significant value add that is difficult to replicate?
That's a very important question, because what I just described was a process earlier, but you might be thinking to yourselves that there's nothing especially unique about it on the surface, and that anybody with a little bit of know-how can put together a similar process. That sounds equally credible. So the question really is, where does the magic happen? And I'll highlight 2 areas on that front that I think are worth noting. The first one being our team, and the second being the tools that we use in order to do what we do. So on the team front, this is the investment team and the people entrusted with making the right decisions for members' investments. We're a strong team, and I know I'm biased here, but I do feel that this is an industry-leading multi-management team. So we cover huge ground in any given year and in great detail as well. Just to give you a sense for that, last year we had over 200 engagements on manager strategies, and that for us is a normal year. And out of each of those engagements comes very high quality insights, which then feed into our decision-making framework. So we go to great lengths to understand the universe, firstly, and then also that level of work is actually quite hard to replicate. And then when it comes to the tools that we use to give us an edge, here we embrace technology, and we've designed tools and systems to allow us to interpret data in sophisticated ways, which help us to look beyond what first meets the eye. Don't worry too much about the detail here, but these are just a couple of snapshots of some of the output that we look at. And the main point I'd like to bring across is that the machinery behind this is really built on quite advanced statistical methods that have been coded in R here, and so it's all automated. And so these 2 outputs, for example, give us a very good sense for the universe out there, and it helps us identify which funds are similar by grouping funds that march to a similar beat. And this gives us very rich insight. And tools such as these are quite hard to actually replicate, and we think add significant value to our process. And then maybe the last point I should make here is that our edge also comes from the fact that we are highly disciplined and in applying those golden rules of investing, successful investing rather. And that includes things like maintaining a long-term focus. It includes staying the course, as well as sensible diversification and risk management in how we actually go about constructing portfolios.
Indeed, I couldn't agree more. And I know there's a lot more that can be said about these models, plus a number more that gets analyzed before a decision is made within our team. So maybe as a final question that ties into both the economic discussions we often have with clients and the macroeconomic discussions that David and Sai had earlier, is how does the team take those economic perspectives and translate it into a house view that we apply across all our portfolios?
I'll keep this one short, Luigi. I realize I might have gone on a bit, but essentially, and in a nutshell, we do have quite a very structured house view process, similar to the process I described earlier. But our house view process obviously combines various elements to make sure that we arrive at a decision that is balanced. You mentioned macro as one of the inputs, and that certainly is one of the important inputs for us. But macro is inherently quite difficult to base a decision on purely, just because of that fluidity of the world and that level of uncertainty that is always out there. But the macro cycle is important for us, and also being a key driver of medium-term asset price returns. And so, therefore, it's quite a key element for us. It's the second pillar of our tactical house view process, as you can see up here on the screen. It is only one pillar for us, though, with the other 2 being valuations, also being a very sort of key driver of long-term returns. And then lastly, we also consider momentum, which for us involves making an assessment of whether the tide is either coming in or going out from a trend and price action perspective. And so we combine these three pillars, we weigh them up, debate them as a team, and then take a view on which asset classes to favor on a 1 to 2 year view. And this slide really just shows our current take on how we think one needs to be positioned from a tactical asset allocation perspective.
Thanks, Rizal. Of course, the proof of the pudding is in the eating. So as the process as discussed here added value to our clients' portfolios. The table that you can see on the screen now shows the performance of the PPS funds over various investment periods until the end of August. Most funds have consistently achieved their benchmarks while outperforming the peer group average as well. So this is particularly evident over the longer term periods, which we believe is as a result of consistently applying our investment process regardless of the changing economic environment. So with that, I'll say thanks to everyone for your time and attention, and now I'll pass over to Razik, who will go through some questions I think that were popping up in the chat.
Thanks so much, Luigi and Lisa. Before you guys run off, the one thing we can't help but notice actually is that there's lots of green. The performance looks phenomenal of the funds. The one that does stand out to me is the flexible income fund. That it isn't a little green, I suppose, at the moment. Do you maybe want to comment on the reasons as to how that fund has performed versus its peers?
Yeah, thanks for highlighting that, Razik. Well spotted. Yes, that is the one fund, I suppose, that has a long enough track record and has 2-star Morningstar rating. The main reason for it is that we've had a less aggressive approach with the flexible income fund. We took the view that clients in that space would want a type of fund that doesn't take on the chance of having too much volatility. And more recently, I think Sai highlighted it as well. Bonds have done particularly well, and bonds does add some volatility in that space. And we've shied away from being too aggressive and holding too much bonds in that portfolio. So funds that have taken on a bit more risk at this moment have been rewarded for that. I must add, though, that the difference in performance in the flexible income space is quite small. So it's only a marginal difference in actual absolute returns, though. But thanks for bringing that one up.
Thanks so much, Luigi. Guys, thanks so much for all your insights. As mentioned, we did make sure we had a little bit of time at the end to be able to handle or answer any questions. I see we have a few questions here on the system for 361. Sai, thanks for joining us. So let's maybe move to the first one here. What's 361's view on shrinking SA equity market?
Yeah, unfortunately, it is a problem. It does make it very difficult to find good investable ideas. I think luckily the South African market is made up of a lot of offshore opportunities. So you've got the likes of the Richmonts, the Anglos, Billiton, BHPs, etc. We've also got some offshore property names that have listed here over the years. I think it's our hope, and I think the JSE recognizes this, that they have to bring more opportunities via secondary listings, dual listings, even inward listings that we're able to invest in, because there is a continual delisting trend that continues, and there's not much incentive to list on the SA market. So, luckily for 361, I think it's almost a relative opportunity for us because we're smaller, so we're able to play a little bit further down the liquidity chain. So we can look at more mid caps and occasionally even a small cap. So it hasn't been as much of an issue for us as it has the larger companies, but it is an issue, and the JSE has to address it.
Excellent stuff. Sai, while you are there, I see two other components also. Just basically your view on property, especially locally, and how you guys are applying it within your portfolio. Yeah, and then also touch on your view on ESG. Perhaps I see we had a combined question.
Yeah, so very much we've got our own full sustainable responsibility team within 361. We have a full framework of ESG, and we actually have a full historical, template where we record all our engagements with management. Every single engagement has to specify whether we've dealt with ESG or not, and which elements of ESG and what conclusions we come to. We in fact score all our portfolios now as well from an ESG perspective to see how they stack up against the index. So very much it's front of mind globally and in South Africa, and we do manage money for some global asset managers, and very much they've been onto us for years around that. We have all the various accreditations, etc. As far as property goes, we had no property from 2017 to 20 in any of our portfolios. In fact, we thought that the sector was very financially engineered. But in the midst of 2020, it did become quite cheap. It wasn't, unfortunately, enormous liquidity, but we did pick up a few good ideas and have been building a bit of a property portfolio. Some of those businesses that don't have too much office look quite attractive, and the yields are, double digit and look like they won't be declining. So I think for risk reward at the moment, there are some good opportunities in that sector, and there have been some very good international inward listed properties which we've held, the likes of Stenprop, etc., which were hardly affected during the COVID time. So I think you can't look at the sector in the whole, because some have re-rated quite significantly and still have big tail issues with office. And in the retail sector, we're seeing some very big negative rental reversions which do concern us. So big re-rating there. Some are good, some a little bit overpriced for us, but I think overall the sector pretty much fairly valued at this stage.
Awesome, so much. Thank you so much, Sai. I see we also have one question listed here. I know we're very quickly running out of time. We just have about 5 minutes left. This one posted towards the portfolio managers, Riza and Luigi. How does the PPSI house view asset allocation work in tandem with underlying manager allocation? Maybe we can elaborate a little bit about how the combination of things go.
Sure, I'll tackle that one. Thanks, Razik. So I took you through our house view process earlier, but that obviously operates independently of our multi-asset managers, which express their own view and own tactical asset allocation processes independently of us. So how we construct portfolios generally is by combining multi-asset managers, such as the PPS managed fund managed by 361, which have their own asset allocation process. So they might be quite negative on SA equity, let's say currently, whereas on the specialist side of our multi-manager portfolios, where we do implement our tactical house view, that is where we actually express our own view. And so we don't look at what the multi-asset managers are doing and then formulate a view. We essentially find that it essentially is quite a nice way of balancing risks. On one side of the portfolio, we're sort of managing peer relative risk, whereas on the other side, we're managing more kind of a real return risk. And so it really is a combination of both multi-asset and specialist, and that's how we address that.
Great stuff. Thanks so much, Riza. I see is emerging markets the way forward, or do developed markets still have legs? US and tech specifically have done well. Are they overvalued? Maybe position more to Sai or David with regards to the economy.
Yeah, so again, I think it depends on the tech story. So I think you can break tech up into two parts. The one, like I spoke of the Google, and obviously we see just now a few minutes ago Microsoft, for example, announcing a $50 billion buyback. I think they're businesses that have proper moats, and those businesses with decent cash flows, decent earnings, and their business models intact, may come off a bit in a sell-off, but I think longer term, those businesses will continue to grow double digits, and the multiples anywhere between 20 and 30 on a forward multiple is kind of acceptable. The ones that obviously we're more scared of are those ones that don't have earnings and the crypto related and the potentially in spaces that haven't been fully recognized yet. On the emerging market versus developed markets, I think it very much depends on particular emerging markets. So in the short term, emerging markets like Russia with very high oil prices are going to do phenomenally well. South Africa, on the one hand, we're very exposed to PGMs that have just halved. There are countries that are more posed towards agricultural commodities. They be quite good. And I think particularly, around China, outside of China, a lot of emerging markets that are not going to have the same regulation as China are actually going to benefit a lot. So there's been a lot of already movement to the likes of like Malaysia and other places like that. And I think there's an interesting opportunity in some of those markets. But overall, I think developed markets still remain a slightly safer place. Currencies in emerging markets have been particularly strong since the start of COVID. And, I think as rates begin to slowly move up in developed markets, we will see some pressure, both on rates in emerging markets and currencies. And we'd probably still prefer to be in the more value-orientated sectors in developed markets versus emerging markets.
Thanks so much, Sai. Maybe just last question from my side. Biggest global concern besides inflation?
Sure. I suppose it's some kind of shock regulation change. We've seen big regulation changes in China. It's arguable that those are in the best interests of the Chinese population over time, even though many capitalists will say they're anti-market. Is to see something potentially change in the US. Many of these big tech giants are not paying any tax. They continually have to stimulate. There's no real space for, new entrants. And, if we start seeing any regulation coming to the US around that, I think we could see some, big surprises. But I still think the biggest risk is inflation and rising yields globally.
Thanks so much. I see we've actually come to the end of our session today. So a huge thank you to Sai, David, Riza, and Luigi for joining us today and sharing such phenomenal insights. We will be sharing a recording of the session as well as the slide pack to all attendees via email. Just on a side note, we've actually recently loaded the PPS Managed Fund to our Lifetime Income Living Annuity product as well. So for more information on the PPS Managed Fund, please speak to your investment specialist, and they will gladly be able to help you. Thank you so much for attending, everybody. Stay safe and go well. Goodbye.
Thank you, everybody. Bye.